What will the markets look like in the next few months?
That's the question at the forefront for investors. We're diving into insights from experts like Joseph Wang, Steve Van Meter, and Ryan King, each armed with years of market experience.
We've harnessed AI technology to distill their hours of analysis into concise summaries that save you precious time.
So strap in as Joseph Wang kicks things off with key economic data affecting today's market outlook.
And remember to stay tuned, because Steve has a warning from the Swiss Central Bank that could shake the markets.
Just a reminder, while we provide expert analysis, always consider your financial situation before investing.
Welcome to Markets Weekly. I'm Joseph Wang, here to provide insights on this week's market dynamics.
This week, we witnessed significant volatility in equity markets, and I will break down the key economic data impacting our outlook.
I believe the S&P 500 is stabilizing after a turbulent period, though several variables will influence its future direction.
Indeed, the inflation data is critical, with recent reports indicating possible seasonal variations rather than sustained inflationary trends.
This week, CPI indicated possible seasonal effects, as January's high inflation figures are unlikely to repeat.
The producer price index was also lower than expected. However, core components suggest ongoing inflation instability.
Joseph detailed recent U.S. tariffs on steel and aluminum, highlighting their significant impact on Canadian trade relations.
He noted that escalating tariffs could create instability, particularly emphasizing Canada's political dynamics.
Looking forward, Joseph predicts that the market may stabilize but remain susceptible to geopolitical and economic changes.
He also anticipates further interest rate cuts from the Fed as they respond to shifting economic signals.
Joseph concludes by advising investors to remain vigilant about inflation indicators and the evolving trade landscape.
He suggests that making strategic adjustments based on economic data and geopolitical events will be crucial in the upcoming months.
Today, we're diving into the recent announcements by the Swiss National Bank, as highlighted by Steve Van Meter.
Steve emphasizes that the SNB is contemplating reducing its policy rate from 0.5% to 0%, amid growing economic pressures.
Steve notes that the SNB isn't an anomaly. It reflects a broader trend where many central banks are slashing rates.
This race to the bottom shows the severe economic conditions many nations are experiencing, which have implications for global markets.
According to Steve, negative consumer prices in Switzerland suggest a shift towards deflation.
This requires central banks to react to economic data rather than anticipate it, a shift from previous cycles. Steve emphasizes that central banks like the Bank of Canada and Sweden are aggressively cutting rates.
The key question arises: how long can the Federal Reserve maintain its position without joining this trend? What can we expect from the Federal Reserve in light of these trends?
Steve predicts that if current economic conditions persist, the Fed won't be able to resist rate cuts much longer.
The consequences of these central bank decisions are vast, impacting consumer behavior and investment strategies.
Steve concludes that as central banks approach zero-rate policies, investors need to focus on long-term strategies in an unpredictable economic landscape.
Today, we're examining an analysis by Nick from Reventure Consulting on whether Donald Trump's policies could lead to a recession in 2025.
Nick warns that several major corporations are issuing significant economic warnings, which could indicate a downturn ahead.
Nick emphasizes the alarming contraction in job openings, citing a nearly 40% decrease over the last 2.5 years.
He also highlights the rise in continuing unemployment claims, suggesting it's increasingly difficult for job seekers to find new employment. Nick points out that Delta Airlines and United Airlines have both issued significant warnings regarding the economic outlook.
Target has similarly warned of disappointing profit expectations, suggesting a slowdown in consumer spending.
According to Nick, cuts in federal spending and subsequent layoffs under the Trump administration are contributing to economic weakness.
He notes that these layoffs among both federal and contracted workers are noticeably impacting economic conditions. Nick references a study by John Burns Consulting indicating that recent declines in immigration directly affect rental housing demand.
If immigration trends continue to decline, there could be a significant drop in rental prices.
Nick notes that pending home sales have dropped 6% compared to the previous year.
He also states that potential buyers are largely waiting for lower prices before re-entering the market.
Nick concludes that the economy may soon face a significant reset, driven by low consumer savings and decreasing government support.
He advises viewers to closely monitor economic indicators and adjust their financial strategies accordingly.
In today's video, we'll review an article detailing warnings from economists about upcoming turmoil in the housing market, focusing on affordability and inventory.
The Economist in the article states that it could take over 7 years to rectify the current housing inventory crisis.
The article predicts it could take more than 7 years to resolve the current housing affordability crisis.
Certain regions like Texas and Florida may recover more quickly than areas in the Northeast, which could face ongoing struggles.
The Economist points out that rising mortgage rates are straining potential buyers' purchasing power.
With rates expected to remain high, many buyers may find themselves priced out of the market.
It's been noted that construction hasn't kept pace with demand, which is a major factor in the affordability crisis.
Ongoing supply chain issues mean that new inventory may emerge slower than needed.
Current affordability metrics indicate that less affordable homes are becoming the norm.
Homeowners are also facing increased property tax and insurance expenses, creating challenges for new buyers.
The Economist predicts that property prices will likely remain high, potentially leading to increased foreclosures.
Navigating the market will be increasingly complex for buyers as economic conditions evolve.
The Economist stresses the importance of thoroughly assessing personal finances before buying.
Planning and budgeting will be essential for anyone looking to navigate this challenging housing market.
Welcome to our discussion on gold market insights with Ryan King.
Today, Ryan provides important insights into what may happen in the gold market and implications for investors.
Ryan, could you elaborate on why you think we are starting a significant supercycle for gold?
I believe that inflation and the depreciation of fiat currencies are major factors supporting gold's ascent.
What insights does Ryan have regarding the current fears of recession affecting consumer behavior?
Ryan highlights that recession fears are front and center, influencing consumer spending patterns.
How has gold been performing according to Ryan?
Ryan mentions that gold has indeed hit all-time highs in many currencies, which illustrates its strength as a valuable asset.
What does Ryan think about the implications of the recent mining merges?
He expects the Calibre and Equinox merger could significantly influence the sector by creating value in current market conditions.
What predictions does Ryan have for future gold prices?
Ryan forecasts that prices could reach $4,000, driven by continuous economic turmoil.
What key strategies should investors consider based on Ryan's insights?
Ryan suggests that keeping a keen eye on gold markets is essential for navigating investment portfolios.
Today, we're taking a closer look at the latest market update from the technical traders, where they analyze the current state of equities and future trends.
The specialist notes that we are witnessing bearish signals in the S&P 500, stressing the need for careful observation of market movements.
The expert identifies that while bearish signals are evident, there remains a possibility for a short-term rally as market cycles bottom out.
Despite a current downtrend, they stress that strategic bounces could still occur in the near term. The technical traders discuss the significant breakdown occurring in the S&P 500, mentioning that more potential sell-off lies ahead after breaking crucial pivot lows.
Indeed, the analysis suggests that the market may be at a critical juncture, primed for potential bounces, but also presenting severe risks. Looking over at the energy markets, the specialist notes that some energy stocks have been trading higher despite the broader market trends.
However, caution is warranted as overbought conditions may lead to sell-offs if they persist. There's an environment of fear and volatility identified, indicating that many investors are currently moving to the sidelines.
The expert emphasizes the importance of closely monitoring these trading patterns, as they could foreshadow significant market movements. What market movements are predicted in the coming weeks?
The technical traders predict a potential bounce of 3 to 6% in the near term, but caution that overall market sentiment remains uncertain.
Looking ahead, what is the overall market outlook?
The expert indicates that bearish sentiment is likely to persist long-term unless there are significant changes in market dynamics.
In conclusion, monitoring the SP 500's behavior around these pivot points will be crucial for investors.
Indeed, while speculative bounces present opportunities, they also entail risks, necessitating careful evaluations.
What a riveting discussion we've had today. Each guest brought such valuable insights.
Absolutely. From the technical trader's expert's analysis of market volatility to Ryan King's thoughts on gold as a safety net.
And I found the Economist's take on the housing market particularly eye-opening. The affordability crisis seems daunting.
Right? And Nick's perspective on the looming recession really added a layer of urgency. It seems like we're all holding our breath.
One thing they all agreed on, though, is just how pivotal central banks are in navigating this uncertainty.
Exactly. But the differing opinions on timelines are fascinating. I mean, are we expecting a quick recovery or a deeper, prolonged struggle?
It's clear that these discussions are vital for making informed decisions.
Indeed. If you found these insights as enlightening as we did, be sure to give us a thumbs up.
And don't forget to subscribe. Your support helps us bring you more crucial financial analyses.
Join us next time as we unpack global trade dynamics and their profound implications for your investments.
You won't want to miss it. Thanks for watching, and see you soon.